some of this is going to be some generic information about source deductions, just to give an overview of what they are. And we'll dive into how we actually calculate the amounts and what previous years installments or remittances, how they affect the current year. So getting started here. I mean, I think everyone here knows who we are. I think most of you guys are clients. We do have this open for non-clients as well, but I'm going to sort of skip over that slide for now. Want to talk about, first of all, what are source deductions. For those of you who don't know, as an employer, you have to remit the CPP, EI, and income tax that you've deducted from your employees to the government. The employees in most situations is actually yourself, which is what creates a lot of confusion. But obviously, if you think back to your last full-time employment, if you were paid $100,000, they didn't actually give you $100,000. They took a portion of that, a big chunk of it, and withheld it from you and gave it back to the government on your behalf. So those remittances are deemed to have been paid on the day in which they're received by the Receiver General. What this means is that your remittance is tied to the threshold and payment amounts. And it's really confusing because there's a lot of different thresholds, a lot of different deadlines, and with our clients, it's even more confusing because we usually only do those remittances once a year, as opposed to a traditional employee where you were doing it every single month. So when we talk about whether or not you even need to make a remittance for 2013, there's a couple of big questions that we have to look at. First of all, do you have income from other sources? For example, if you came from a full-time position prior to incorporating, you probably got income already, and if it's lower than the lowest, or sorry, greater than the lowest personal tax bracket, odds are we don't want to declare any income for you, so you won't need to make any remittances at all. In addition, as a situation that was addressed before we started recording this, was, well, if I have my corporation and my corporation bonus forward income, do I need to make a remittance because I've already put some income into 2013, and how's that going to affect how much I'm going to have on my T4, and do I need to add any more? Basically, we work these decisions around the amount of money that you're actually pulling from the corporation and around the various tax brackets. There's two major tax brackets at the federal level that we tend to work around. They're in the general area of about $42,000 and about $85,000. If you're pulling a lot of money out of your corporation, you're probably going to be up to that second tax bracket. If you're moderate or average, the ideal is to keep you to that lowest tax bracket, but sometimes that's not that easy to live on $42,000 plus your deductible business expenses. So the question becomes, like I said, do you have more than those tax brackets from other sources? So for example, if you had 8 months of income at another at full-time employment and you had $100,000, then we definitely are not going to want to give you any income from your corporation. We'll worry about any money that's come out of the corporation in your next fiscal year and bonus that into the next calendar year. Again, if we've declared income from your other corporation and it's more than those tax brackets, then again, we're probably not going to add any more. But big thing here, though, is how much have you actually withdrawn from your corporation? Because if we, for example, had income from previous years that we bonused into 2013, and that's over $80,000, but you've drawn out of your corporation $200,000, then we're probably going to need to exceed that. So really it comes down to how much money you've withdrawn since your last corporate year end. Of course, the other factors here how much money will you actually contribute to your RSPs, because this will reduce the amount of deductions that you have to remit. Do you have a target income that you'd like to hit? Because, well, most of the tax planning is guided by how much money you've withdrawn from your corporation. We do have a little bit of flexibility. There are strategies for deferral. There are also strategies for loans. So there's a couple loopholes that we can use to play around with how much salary we'll actually give you. And of course, income splitting with family members. The more family members that we have, the more income we can get out at the low tax brackets, and the less source deductions, or I guess not even necessarily the less source deductions, but the lower the average tax rate will be. Because you might end up with higher source deductions, but at lower effective tax rate. One of the other things to talk about is effective tax versus marginal tax. Something I go through with most of you during our year-end reviews, because I think it's such an important thing to understand. Marginal tax is the highest tax rate that you will reach personally, whereas effective tax is just the total taxes that you've paid divided by the net income. And so that gets you your effective tax rate. Effective tax rate is always lower than corporate taxes, or sorry, than marginal taxes, because the marginal tax rate, as I said, is the highest tax rate you achieve. The effective tax rate includes your basic personal exemptions and the income that's taxed at the lower rates. So once we've figured out an amount, we have to figure out what type of remitter type you are and when that's going to be due, because as I mentioned before, there's a number of different deadlines and a number of different remitter types. So the remitter due date is actually always based on the payday and also on your threshold. Of course, if your due date for this is a Saturday, Sunday, or public holiday, you actually get the extra day. If your business does happen to go bankrupt, you must remit all your deductions within 7 days. But I don't think that's hopefully going to be a factor for any of our clients. Now, determining what the actual due date is determined by your threshold. Now, I am going to actually mute a couple people here. I've got some requests. So I might actually see, I'm going to mute a couple people. If you do have a question, maybe you could just raise a chat window. Bear with me 1 second here, everybody. I've got you all muted right now. So if you do need to raise a question, you will need to sort of open a chat question here. And the other question I did have is, will I be sharing the videos afterwards? Yes, I'll be sharing both the slide deck, and we are also recording this video. So sorry, I got a little bit off topic there. Now we're talking about average monthly withholding amount. This is how they determine what your threshold is going to be, and from that, your deadline. So they're looking at the information from 2 calendar years ago, and that's how they determine what your average monthly withholding amount is. So based on your average monthly withholding amount, if you're less than $15,000, then you're a regular remitter, and it's due the 15th of the following month. If you're a threshold 1 remitter, then your average monthly withholding amount would be $15,000 to $49,999, and it'll be due on the 10th amount. If it's more than $50,000, then you're a threshold 2, and you're due on the 3rd. There's also a quarterly remitter if you're less than $3,000, and you meet certain levels of criteria. Finally, it's worth noting that with associated corporations, it's based on the combined amount. So if you have multiple corporations or multiple payroll accounts, then everything is based on the combined amounts. Now, what gets a little bit confusing is we're talking about average monthly withholding amounts here. But for most of our clients, we're declaring the entire salary as a bonus in 1 month. So, of course, this is going to be the total remittance for you. Most of our clients do fall in the threshold 1 or threshold 2 range. But we usually tell people to, the threshold 1 or the regular remitter range, and we usually tell people to target the 10th deadline. Even if your deadline is the 15th, it just gives you a bit of extra leeway to be aware of, or to give you some heads up. Now, if you are brand new, if this is the first time you've ever actually remitted payroll, then there's a couple things you need to do. You need to make sure that you've registered a business number, which if we've incorporated you, we've done that already. You're also going to be considered a regular remitter, so your deadline is going to be the 15th. And you're going to receive your remittance form in the mail after you register. Now, the remittance form is important because depending upon the payment method that you're making, you will need your remittance form. And these remittance forms are specific to you, and you can't go and we can't print them off for you. The only thing you can do is go on to your CRA My Business account to print those, because on the CRA My Business account, they do have any mailings that have ever been sent to you. If you are making an electronic payment, then you do not have to have that remittance voucher or an ATM. Both of those payment methods, you don't need the remittance voucher. However, if you are making any other payment, oh, sorry, I apologize. That's not true. By mail, you also do not need the remittance voucher. You can send a payment with the check and the RP number directly to them. So if you were sending it by your financial institution, like if you want to walk into your bank to pay this, you will need to have your remittance form with you. And we will walk through with you how to complete that remittance form. But there's basic information that they're going to be looking for, which is the number of employees. Most cases, there's usually only one. But if you've done any income splitting, obviously, anyone that you're doing income splitting with is going to count as an employee. They're going to look for the gross payroll amount, or the total amount of salary that's being declared that's going to go on the T4, and the remittance amount. So those are the three things that they're going to be looking for on that form. So with paying at your financial institution, you can do that, I guess, these days, either at the physical location, online at your bank, or through their telephone banking. If you are using the ATM, you've got to be aware that you've got to give it a little bit of time, because an ATM receipt isn't going to count as sort of documentation that it was received at that time. You will have to give it a day or two for the payment to actually process. So those are the things important to note about online and ATM payments. Again, with mail, you want to give it the appropriate time so that it can get through the appropriate channels and make it there in time for your deadline. The last thing that a lot of people aren't aware of is that you can actually make payment arrangements with CRA. The payroll deductions should be held in trust with the Receiver General in a separate account. And if you, for any reason, cannot pay your balance, you can always call CRA and make an arrangement with them. You should always, of course, be as upfront with them and get in contact with them as soon as possible. They will charge you some interest, and depending upon the payment arrangement, may or may not charge you the penalty. So if you don't think you can make it, make the installments, you should give them a call. Another little known loophole is that if you don't have enough to make the payroll remittance, as long as you make the minimum CPP payment, like if you pay all the CPP, but not the tax, that it's a little bit of a loophole. They won't charge you a penalty. They will still charge you the interest on the tax, or sorry, no, they won't even charge you the interest as long as you pay by April 30th, which is your deadline. If you miss the April 30th deadline, they will charge you interest on the tax. That's not documented on the Income Tax Act, but it is a general policy that we have seen has been accepted by CRA. Now, talking a little bit more against these remittance forms. I learned I should have moved this slide up a little bit earlier, I guess. But the remittance forms, like I said, they're personalized to tie into your payment threshold and your deadlines. You've got to complete the remittance form. It's just the bottom part that you're remitting so that CRA can obviously assign everything properly. If you do receive a notice of assessment that states you have an amount owing, you should use that form for the amount owing. So sometimes you'll make a payment and they disagree with that amount. They'll send you a reassessment amount. You should use that specific form, not one of the generic forms they might have sent you for just the regular monthly remittance. So the forms that they have are PD7A, PD7A-TM, PD7A RP. They all pretty much look the same. If you ever have any questions about which form you need to use, you can give us a call and we'll walk you through that. If you're not making a remittance, which happens quite frequently with our clients, because what's going to happen is, as I mentioned earlier, they're going to expect you to make a remittance every month because they're assuming your employees are being paid every month. However, with our clients, we're basically paying you once a year, sometimes twice a year, but certainly not every month. So what's going to happen is right after you make that first payment and you have a subsequent month in which you don't make a payment, they're going to send you a form saying, how come you haven't made any additional remittances? Now, you can notify them that you have no employees with any eligible remittances, either online through their tele-reply or by mail. Usually the simplest way is to just give them a call and say, listen, I have no employees with any eligible remittances, and I won't have any until next December. Keep it short and sweet. You don't need to go into any elaborate details about, well, when I pull money out of my corporation, it's direct, or it's a loan from the corporation. The more you go into that, the more you're likely to create confusion and them to have additional questions. So, like I said, there's 3 different methods that you can do that to notify them that you're not going to be making a remittance. There's also a couple of different things that you need to be aware of in regards to how you can correct payroll remitting errors. This is one of the questions we had earlier. Obviously, there's a couple of common problems. You've under-remitted, you've over-remitted, or you've remitted the right amount and they've applied it to the wrong account. So if you've under-remitted, obviously you need to remit any shortages as soon as possible using any of the payment methods that you have available. Of course, if you don't have a remittance form, send your check or money order just straight to the Receiver General and include a short note that states what the account number is and the month or period that it is relating to. If you've over-remitted, there's a couple of options. You can reduce your next remittance amount by the overpayment, or you can contact CRA and tell them about the over-remittance and ask for a refund. We don't like to do this as it tends to create a lot of unnecessary tension, but if, sorry guys, if there are issues related to that where we have indeed made an over-remittance due to an error, you are still eligible to get it back. But like I said, it does tend to cause a lot of unnecessary attention. The other most common issue is that there's a misapplied payment. So you made your payment on time, but CRA, for whatever reason, has applied it to corporate tax or HST. Really simple to resolve. We simply give CRA a call at their 1-800 number and let them know that the payment was indeed for payroll and for what period, and they will reallocate it, and you won't have any, they will consider the payment, whatever they receive that payment is the payment date that they will count for the remittance, not the date it was reallocated. So those are common issues that we see quite frequently that are very easily resolved. Failure to deduct penalties. These are fairly significant. As we mentioned, sorry, I don't know what's going on with my computer today, guys. If you miss your deadline, CRA can assess a penalty of up to 10%. This is one of the most significant penalties in tax, so we really don't want to miss this deadline. As I was saying before, if you, for whatever reason, absolutely cannot make your deadline, it's important to get in touch with CRA and us as early as possible so we can work out a payment arrangement with them or come up with some solutions. The other thing to note is that if you've missed your deadline more than once, CRA may potentially apply a 20% penalty. So like I said, these penalties can be fairly significant. Now, one of the other things I wanted to go just before I open this up to questions is through the forms that, well, first of all, I think I'm going to go through, there's a couple things I want to go through. First is sort of some tax brackets for everyone to be aware of. So the basic federal exemption is about $11,038. So this is the minimum amount that I'd recommend anyone take because you're getting this virtually tax-free. The next threshold is about $43,000, and this is the top of the lowest tax bracket. And usually when we look at long-term planning, this is sort of the minimum amount I would recommend that anyone take because, well, it might be a little bit cheaper in the short run to get money, leave money in the corporation. It's better in the long run. This is the cheapest money you will ever get money out of the corporation. So if you have net income in your corporation greater than $43,000, I generally speaking recommend pulling it out and paying yourself a salary of at least $43,000. The next tax bracket is about $87,000. Now, this tax bracket we usually only recommend for those people who have, you know, higher personal spending. So if you're drawing out more than 43, then ideally we want to sort of target the effective net income of about $87,000. So these are some of the thresholds or targets that we tend to work around. Now the other thing we want to talk about is this form that we have sent your way. And I know that it can be really confusing, and there's probably a lot of questions about what you need to fill in and whether you actually need to fill in this form. So let's go over, first of all, who it's relevant to. If this is your first year of being incorporated, and we have not completed your year-end yet, this is relevant to you. If your year-end is in the second 6 months of the year, July, August, September, October, November, December, and we have not completed your 2013 year-end as of yet, this is going to be relevant for you. For first-year people, obviously there's no amount bonus forward. If your year-end is in the second 6 months of the year and we haven't completed your year-end yet, we have to take into account the amount we've bonused forward and the drawings that you pulled out so far to figure out where we want to target your income for the total salary for 2013. Obviously, we've got some basic contact information that we want to have here, corporate names, social insurance numbers. If there's been any changes in addresses, we would like to have that information there. Next, we're going to try to get an estimate of the gross income for the corporate tax year. This is obviously because we don't have the final information yet. If we've completed your year-end, we have the final information, we've been able to make the tax planning as accurate as we possibly can. If we haven't done the year-end, we're trying to get an estimate of what the net income is and what the money you've pulled out of the corporation is. Because if the money you've pulled out of the corporation is small but the net income is high, we might want to actually give you more salary than what you've actually pulled out of the corporation. So the other question we have is, so we're asking what's the estimated corporate income, what's the estimated money you've pulled out of your corporation, and any home or auto loan repayments. Now, a lot of that, the home and auto loans, probably not that critical because we'll have that information available. The one thing that's important to note is if you have new home or auto loans that you might want to set up. So for those of you who are new, you may not be aware of what a home or auto loan is, but if you purchase a car or a home, we have the option of taking the money that you pulled out of the corporation for those purchases and calling them loans instead of salaries. Again, if any of you have some specific questions, we can come back to those in a second. The sole proprietorships is just, we're trying to figure out if you switch from sole proprietorship to perm, again, trying to figure out how much of the money is going to go into the sole proprietorship, how much is going into the corporation. And then here comes the meat of it here. We're trying to estimate the amounts and the desired tax brackets that we're going to calculate for you so that we can determine what the actual remittance amounts will be. Based on the income that you have from other sources, any taxable benefits you have, dividends, all these other sources of income will help try to figure out a target net income for you and determine the actual threshold amount. So basically, any amounts that you know you'll want to complete. Now, obviously, a lot of these fields are going to be left blank, but complete as many of them as you possibly can and submit that to us. If you still get stuck and you're not sure what to do with this form, just give your account manager, either myself, Sean, or Syed, a call, and we'll be happy to sit with you and take a few minutes to just answer some simple questions and try to figure out where we want to target your income. And of course, based on your income is what your remittances are going to be. That is my first attempt at this source deduction seminar. I know I've spewed through a lot of information. Some of it will be relevant to you, some of it may not. I'm going to open the audio up now and unmute everyone here. So just give me a second, and I'll open the floor to any questions that you might have. There we go. So I think I have everyone unmuted now, and I just sort of brain dumped a lot of information on you. Is there any questions that you have?
Yeah, Gavin. With respect to the income from other sources question or point that you brought up, is that like I formed my company halfway through the year, and the income from the other sources was before I'd formed the company. So is that the context that you're talking about, or would it be multiple sources of income into the corporation?
Yeah, what we're more talking about the income, like you said, that you had prior to you setting up your corporation, because they've given you a T4 for that income you had in the first 6 months, and if that income is above the high tax or the middle tax bracket, we probably don't want to give you any income at all.
Okay.
So if you're more than $87,000 in income from other sources,
yep,
we don't really want to top you up because you're going to be into the highest tax bracket anyways. So even if you're going to end up being into the higher tax bracket in 2014, we might as well defer it because you'll buy yourself a year between when you have to pay your taxes. And our philosophy, obviously, taxes deferred is money saved because it gives you access to the time value of the money.
Right.
Can you go back to the previous sheet that had the tax brackets on it?
Sure. No,
Thanks. I don't have a specific question. I just was looking.
I'll also make all of these spreadsheets available for everyone with the thresholds. I actually realized a few minutes before the presentation that I should have put the tax brackets into the presentation. Version 2 of this presentation will have those in there, but I'll make those available for everyone as well. Obviously, these will change year to year, you know. And I guess one of the other things too is that we don't really touch on this presentation because it's focused on the source deduction, is that there is another strategy for withdrawing money from your corporation, and that's a dividend. Now, source deductions are specific to salary. Generally speaking, in your income earning years, we do recommend that you take a salary because it is eligible for CPP and it is eligible for RSPs, two philosophies that I personally believe in. However, if you don't believe in the value of CPP and you don't believe in the value in RSPs, then it would actually be less cash flow for you to go with a dividend. And with a dividend, we still have a deadline to create a T5 for you by the end of February, but there's no deadline to make a remittance by the first week of January. So something that people may have some more questions on, and actually probably something I should probably work into this presentation as well.
It's Gavin again. Are all of these slides available online, or can you circulate them to the attendees?
I will do both. I will make them available online. So I'm going to put the link up on our website under the Source Deduction Seminar to both the PowerPoint and also to the recording that I made. And I'll have Gene shoot out an email to all of you
Okay.
with a copy of the PowerPoint and the two spreadsheets that we've referenced here.
Andrew?
Yep.
Andrew? It's Garnet McKay. I just incorporated my company in July of 2013, so I'm a real newcomer here. My year end is May of 2014.
Yeah.
I have income already from a pension, an employer pension, and also I have RSPs that I can and do draw some funds from. So in my situation, I was thinking that I should probably divert most of my withdrawals to my spouse, who has virtually no income, and do it that way. Is that a logical way to do this?
Yeah, it's definitely a logical way. The only issue we have with declaring salaries for the spouse, obviously, is the reasonableness test. We just need to make sure that the amount we're declaring is reasonable. But yeah, we're probably going to want to certainly do some income to your spouse. The question is how much and whether or not we want to do it as a dividend or a salary. Dividend or salary to the spouse question is probably going to be determined by the amount. It might be worthwhile for you to give me a call after this where we can talk privately about the amount, and I can give you my recommendation on that, because I would say sorry, go ahead.
I should send you some information first, so you'd have some background on what my incomes are and what my wife's income. I mean, I've done my last year's income tax, so maybe I'll do that, Andrew. Then once you have that, you probably can talk more intelligently to it.
That sounds perfect.
Thank you.
Hi, it's Adam Deutsch here.
Hi, Adam.
Can you go back to the other spreadsheet and talk a little bit about lines number 41, 42, 44, and 45, or rows number? Now I'm looking at the one from your emails. I don't know if it's.
Hopefully I think it's the same.
Yeah.
Yeah. 41, 42, 43, 44, and 45, right?
Yeah.
These are yellow ones, I guess. Probably.
Yes.
So estimate of gross corporate revenue up to the next year end. So we're just trying to figure out what the gross income of the corporation is. Again, the purpose of this is to try to figure out, what tax bracket we're going to target. Because if you make $200,000 a year, it's probably not going to be a good idea to target the lowest tax bracket as a good tax strategy. We also want to look at the total expenses from the corporation, because if you are $200,000 a year corporation, but you have $200,000 a year in expenses other than your own income, again, we don't need to worry about the highest tax bracket in that situation. So these things all sort of play off each other. And then, of course, we want to know how much money that you've actually pulled out of the corporation. For example, again, $200,000 a year company, but the guy happens to be very frugal and lives off $20,000 a year, he can actually target the lowest tax bracket. So based on all of these, it's helping us to pinpoint where we think you will want to be in that spectrum of salary, because obviously there's no right or wrong at this. We're just doing our best to sort of say, okay, based on your living expenses, based on how much money you're pulling out of the corporation, based on how much money you're earning, we think a good salary for you is going to be X.
Okay, I guess what I find a little disconcerting is that all three of these are estimates, and because there can be considerable variation. I mean, basically, the way I'm doing things is that all expenses, practically all expenses, are being paid as what do you call them? Director's advances for all the money coming out, and then all the expenses are expenses paid by director.
Yeah.
And so, to get an accurate number, I would need to take the director's advances and then subtract the expenses paid by director, and that would give me the net amount. But I don't see that calculation is, or any attempt to do that calculation is being done anywhere here.
Yeah, that's effectively what we're trying to get to. We may not make it very clear here, but that's what we're trying to get to by saying, okay, how much money have you pulled out of your corp? How much have you paid in deductible expenses? That, I agree with you. This spreadsheet, to be honest, I don't like it at all. I'm trying to work to revamp this process and make it clear, because I think it's not that clear for our clients. I'm very open to any feedback, suggestions on how we can make this spreadsheet better, but you hit the nail on the head. The exact point of what we're trying to get to is how much money have you pulled out of your corporation. We're asking for estimates of these amounts because obviously you're not going to necessarily know the exact, at least by December 31st. The other thing is to note is it doesn't also have to be dead on accurate, because if your year end is the second 6 months of the year, if we underestimate that amount, then we can actually end up bonus forwarding. When we sit down and do your final year end, and we crunch the numbers and we go, ooh, we gave Adam, $10,000 less income than he actually remitted, then what will happen is that can be bonus forward into the next year.
That's okay. In my particular case, it's at the end of March, so I'm in the first 6 months of the year.
Yeah, exactly.
So what you're saying is the exact amount doesn't really matter that much. That it'll be sort of reconciled at the end of the corporate year.
Yeah, it's one of the things that's really hard for people to grasp is that a lot of accounting isn't actually exact. A lot of accounting is sort of guesswork, and then it gets corrected and exacted at the year end.
Yeah, I am one of those people who is uncomfortable with that.
Yeah. I think IT guys in general are uncomfortable with it. You're used to ones and zeros. Programming doesn't work if it's not exact.
Because my naive calculation would be, okay, I had a certain amount bonused forward at the end of my last corporate year end.
Yep.
Then I will have withdrawn a certain amount by December 31st at the end of the calendar year.
Yep.
And then I will have paid a certain amount of expenses out of pocket by December 31st. So my naive approach would be to figure out how much net has come out and then compare that to what was bonused forward. And it's, I don't know. So I guess maybe all I should do is just fill in these 3 rows here and let you come up with your best recommendation.
What the reality is what we're trying to get is to get a little bit of financial information beforehand. What's going to happen is when we get this, likely we're going to give you a call and work through some of these. This just gives us a little bit of information, because these are the types of questions we're going to ask you on the phone call anyways. So we're trying to get that information, then we'll have a conversation with you to sort of say, okay, look, based on the information that we're seeing, this is what we believe the drawings are going to be. Now, one of the slight confusions is, so you have the amount that you bonus forward, and then you've drawn out drawings throughout the year. The drawings throughout the year, the net drawings, whatever those are going to be, are going to go on top of the money you've already bonus forward. Because the bonus forward amount you have was the drawings from the previous year that we hadn't got the number right on. So that's the minimum amount of tax that we've got to, like that salary is like, that's a given. That's going on your T4 no matter what. we're going to want to add on to that T4 any other drawings you pulled out of this year.
Well, maybe I should talk to you about it privately, because my understanding was that actually this was the bonus forward was actually anticipating drawings I would be making. It wasn't actually drawings I had made in 2012.
Well, and that's why we got to always talk specifics, because in many cases we're just dealing with what's already happened, but with some clients we're preemptive, and it's always we always prefer to be preemptive. And what we've even done for some clients is we've been preemptive to the point where you actually don't even need to worry about this thing, because we sat down at the beginning of last year and we said, look, this is what we see what your annual drawings are throughout the year, so this is what we think your salary is going to be. And as long as you haven't exceeded that threshold, that plan that we had for you at the beginning of the year, there's going to be no need to gross up the salary. Now what's going to happen is this is just your last opportunity to say, okay, when we sat down and we did the planning, the preemptive planning for the year, and we thought we could target the lowest tax bracket, well, it turns out, you know what, I've spent a lot more than I expected, and now we need to target the second tax bracket.
So, yeah, I think that
Andrew?
Sorry, go ahead.
Andrew, it's Lou Clements. I have a question.
Hi, Lou. How you doing?
Can you hear me?
Yep, go ahead.
Hi there. I'm welcome. Did I just hear you plan this proper? We plan this properly. In effect, you could bonus yourself the entire year's income at the beginning of the year versus waiting until the end of the year to take out that income.
Exactly.
If you've got some confidence in your projected revenues.
Yes. Now, the only problem, some people don't like to do that because it means you're out of pocket your taxes a little bit sooner. But from a planning perspective, it saves you the headache of having to come back and do this conversation right now. And if that planning has been done last year for the year, and we've targeted and we're reasonably accurate on that, we don't need to make any adjustments right now at all. And certainly one of the things that we've been focusing on is to try and do that more and more,
So in theory, wrap up, yeah, so normally figure out my salary for the year, pay my income tax, and then get into next year. This year, I could do that for the end of fiscal 13, and I could preemptively pay myself an amount for fiscal 14 as a bonus that in effect could end up being my entire salary for 2000.
Yes, you could, and then you wouldn't have to come back and go through this whole sort of source deduction headache at all right now.
I'd like to come back and see you guys. Right. Okay, it's very useful.
Hopefully this...
But I wouldn't be able to have to speak about revenues, not this year's revenues.
Sorry, I apologize, Lou. I didn't get much of that. You were your audio was breaking up a little bit. I killed my webcam in hopes of maybe getting a little bit better.
Oh, I'm sorry. Okay, so I would come in. We could figure out my connection. Huh. Okay, I've got a brand new system. How's that?
I think it's much better now than it was before.
Is it? Okay, I apologize. So a person could figure out fiscal 13 based on pretty well estimated revenues, given we're in November, and then I could project revenues for 2014, pay myself a bonus, and that could in fact be my income for 2014 if we get it right. Is that right?
That's correct.
Okay, good.
Is that really correct? Because I detect that when you use bonus forward, that doesn't necessarily mean paying yourself a bonus. It means paying the source deductions in advance. Or am I confusing things?
Well, it's dependent on your year-end date, right? But when we say bonus forward, what we tend to mean is pushing income from the current calendar year to the next calendar year. You have the ability to declare income in any of the 12 months within your corporate year-end, plus up to 6 months from the end of your corporate year-end date. So we tend to refer to bonusing forward, pushing out into that 6 months after your year-end date. But so basically, I mean, you have essentially 18 months in which you can declare revenue. And depending upon your year-end date, that means different things. Like, for example, if your year-end is in the first 6 months of the year and you bonus out 6 months, that's the same calendar year. If your year-end is the last 6 months of the year and you bonus out, that's actually into the next fiscal year. So that terminology means different things depending upon your year-end date. So to someone in the second 6 months, bonusing out usually means pushing into the next calendar year. To someone who has a year-end in the first 6 months of the date, bonusing out is actually still the same calendar year. So I apologize. What's hard here is some of you guys have different year-ends, and so it means completely different things to you guys. I hope that helps.
No, for me, that's helpful.
Andrew?
Yep.
As I said, it's Garnet McKay. As I told you earlier, I just incorporated this year. I think from this conversations we've had, I don't really need to do any remittances by December 31st, for lack of a better date. This year, I can hold off and do them next year. Is like even as after my year end.
Yeah, definitively, you can. You're not obligated to, given your year-end date, you're not obligated to take any income in 2013. The only reason we might want to is, like, for example, you mentioned we might want to give something to your wife. So obviously, if we go past January deadline and then decide we want to give something to your wife, well, we're into a penalty situation.
Okay, so I need to make a decision on my spouse in particular.
Yeah.
Thank you. I'll be in touch, Andrew, once I get some numbers in my head together. Okay.
Thanks, Garnet. It was a pleasure chatting with you.
Thank you.
And Andrew, it's Lou again. Another question.
Sure.
With dividends, do you have to declare an equal dividend for all shareholders, or can you be selective and declare a dividend for one shareholder?
Depends on your share structure. If you have different classes of shares for each shareholder, you can do different amounts for different classes of shares. If you have the same amount of the same types of shares, you have to do the same amount of dividends.
So I incorporated through you,
and
you guys set up A, B, C, and D.
Yeah. So we can do different dividends to different people.
Okay. Thank you.
Any other questions for me today? I guess we'll wrap it up then. Thank you, everyone, for attending. I know, like I said, it was a little bit rocky. It was my first attempt at this. I'd love feedback if you guys have any suggestions on things we can do to make it better for clients in the future. Or if you have other questions, please feel free to email me, and I'll be happy to follow up.
So you'll be sending out an email that gives us the links to the files?
Yes, I will. It might not come until it might be till Monday, but I will send out a link to everything.
Okay.
Andrew, I just have one very quick question, and that is, if just because of those two ranges that you have, $43,000 and $80-something thousand, that basically gives you a big margin for these estimates, right? That's where you get your error margin. You know, it's pretty high because of those two brackets. If someone believes in CPP and basically the RSP, right? Is that what? Like, I mean, I'm trying to recap one more time at the end, right?
Yeah, no, those two tax brackets are just good targets that we use. You might end up falling somewhere else, like you might fall in the middle of those two, but those are sort of two tax brackets that I like to use as minimum threshold. For example, if you're an average person, you want to take at least 42.7. If you're a high-income person, you probably want to take at least the 87. And I would say that those minimum tax brackets plus your RRSP contributions. Because, for example, if you're at 42,000 and you contribute 10,000 to your RRSPs, that's going to actually bring you below the lowest tax bracket. So you want to actually do 42,000 plus whatever your RSP contribution, let's say it's 10,000, then we'd give you 52,700. That way, when you have your income minus your RSP, you're right at the top of that second tax bracket.
Okay.
Now, there's no right or wrong to this. This is my personal approach because I think that results in the best long-term strategy as far as getting money out of the corporation.
Sorry, I have one more question, Adam Deutsch. And it's slightly off topic, but what is your philosophy concerning TFSA, tax-free savings accounts? Is it a good idea to try to maximize the amount?
Yes and no. It depends on your personal situation. I'm generally speaking a big fan because TFSAs, you have the ability to pull money out and put it back in. And for IT consultants with potential gaps in contracts, it's a great safety net. So I'm usually a big fan of TFSAs. Plus, of course, if you're actually generating a good return on your investments, you're getting that growth tax-free. The only caveat I say to that is if you are already into the highest tax brackets, I'm not a huge fan because to put money into your TFSA, you got to pull money out and pay taxes at 46% in order to put it into your TFSA.
Right.
So if you're in the low to middle tax brackets, I'm a huge fan.
Okay, thanks. That helps.
Thank you.
Okay, thanks everyone.
Thanks.
Thank
and
you.
For those people who were on last week's bookkeeping seminar, the link is coming. Unfortunately, I did have some problems with the audio, so the recording of the actual seminar did not work, but we'll put the PowerPoint up and send that out to you. So I apologize. There was a delay because the recording did not work properly.
Any chance that new folks can, who weren't part of the group last week, are able to get a copy of those slides as well?
Yeah, what we'll be doing is we'll actually, you can either email me a request, but what we'll do is we'll put them up on the website. So if you go to our website, you go under seminars. If you click on it, I'm going to put the links to the content under the individual seminars. But if anyone just sends me an email, I'll be sure to follow up with the content. And yeah, if I get a proper recording on the next bookkeeping seminar, I will shoot that out to the original attendees as well. So hopefully, cross our fingers that the recording for this one worked. I think it did, though. Okay,
Thank you very much.
Thank you, guys, and I hope you have a great day. Bye for now.
Thanks.
Thank you.
Bye.
Be in touch.